Welcome to Market Domination. I'm Julie Hyman, and that's Josh Lipton. And we were just listening to Nvidia CEO Jensen Huang making some announcements at Nvidia's annual GTC event. Most recently showing off a robot there on stage. Joining us now is Cody Acre, a Benchmark Company Managing Director and Senior Semiconductor Research Analyst. Cody, obviously you were watching as well. Any big takeaways here? It was sort of fleshing out some of the bones of which we were aware of already, right?
I think that's really been more of the nuts and bolts of the keynote was really just a bit more details around what we knew was already in the works. Ultra and Rubin and now Hyman in 28. That was incremental. We have not heard much about that in the past, but for the most part, it was a lot of incremental details that were relatively small.
Cody, I remember when Nvidia last reported financial results and we had, other smart financial analysts on like yourself, your colleagues on the street, and I asked them, hey, okay, what is the next big catalyst for the stock? And some of them, Cody, told us it was GTC, but I look right now, the stock's down about, nearly 2.5%. Was there something, Cody, investors were hoping for that they didn't hear today?
That we're just hoping for more, maybe more details, maybe something about an acceleration of Rubin. But with Rubin, it looks like it's not coming until the second half of 26 now. That maybe the street had been more optimistic about its launch, but I think the realism is that Blackwell Ultra is going to carry the water here for the next 12 months, and then we'll be looking at Rubin beyond that. But it is obviously a bit of a disappointment from street expectations with the stock being off today.
Cody, I can't help but think of a parallel perhaps with Apple, right? Another company, obviously more consumer facing, but another company that has annual conferences where it rolls out new product, but maybe a little bit of diminishing returns after a while. In other words, obviously it was a huge leap when Nvidia first came out with Blackwell. Is it inevitably not going to be able to match the magnitude of that leap on a regular basis?
Yeah, Julia, I think you're right. I think that once we have the basic schematics or the basic roadmap down, that gets factored into the stock very quickly. And unfortunately, the AI trade has been soft for the better part of this year, really since DeepSeek started to take the wind out of the AI trade a couple months ago, and that has we've been looking for a reason to get back involved, and the hope had been that GTC would be that reason. But I think that was an overestimation of what Nvidia was going to say. I really was not surprised that we didn't hear more specifics or more encouraging stock catalyst out of this. I don't think that's what this format was for.
So, Cody, with the stock down now 13% year to date, what gets it moving again in the right direction?
Well, it's just going to be earnings, and I think Nvidia goes back to a block and tackle story that they continue to deliver upside. They continue to guide higher. They continue to grow into the transition, which was delayed from Blackwell as they get into Blackwell Ultra, and that starts to get them more momentum to their earnings base, and that's what investors are ultimately paying for. And so I think we just go back to a beat and raise story around earnings.
Well, and that remains the story, right? To be clear, do you think that there is any demand slowdown, threat of a demand slowdown, any kind of issue there with what's actually happening with the existing product?
No, I don't think there is. I think if anything, things are accelerating. I think you're seeing that in the capex budgets of the cloud service providers. Those are only increasing, and we are seeing the compute density as we're moving to more reasoning models. And even DeepSeek showed that reasoning models with more compute perform better. And so the air that was taken out of the AI trade around DeepSeek was, I think, over exaggerated and inflammatory, largely based on the trend of reasoning that just drives compute density higher. And I think that has been just misunderstood by the industry, is that as we move to these higher reasoning models, that they are going to consume whatever compute NVIDIA is able to provide.
Cody, you mentioned a point there I just want to come back to, because in the hyperscaler specifically, because I think for a lot of NVIDIA investors, Cody, they kind of keep it simple. They just think as long as the hyperscalers, as long as the big cloud giants, keep spending to build out their AI infrastructure, hey, that's good news for NVIDIA, that's more GPUs. How confident are you, though, Cody, that you're going to keep seeing this really eye-popping CapEx growth in not just this year, Cody, but 2026, 2027?
I don't think, Josh, there's any reason to doubt that we will need more compute horsepower in the future than we have today. That AI is becoming pervasive throughout all industries, whether it's industrial, automotive, pharmaceutical, mining, any kind of delivery logistics. We're seeing it become pervasive throughout multiple verticals, and the more they use it, the more they need to rely on the cloud service providers for infrastructure. And so you're seeing companies like Oracle come on as a major supplier of resources. That's relatively recent development, but it's come on as we've seen enterprises adopt AI and need those resources on an outsourced basis. And so I think that the cloud service providers will continue to spend to capitalize on that trend, which I don't see any reason that it stops unless the implementation of AI stops. And there's no reason that slows as long as productivity increases are available.
So would it stop or slow if indeed some of the worst concerns about the economy right now come to pass? In other words, as you know, of course, there's a lot of concerns about tariffs, about the effect on the economy. We've seen some hits to consumer confidence. Do you have any concerns that is going to affect the future pace of AI spending?
I do, Julie. I think the pace of spending is going to be very economically sensitive, and there is big concerns in my mind and at our firm of a slowdown in our GDP trends and the global impact that tariffs are likely to have. And that is going to be a direct correlation to enterprise willingness to spend. That has to impact, there has to be a certain sensitivity to economic direction. And I think that is the biggest risk to AI. I don't think it changes the long-term adoption. I think it simply causes a pause as corporations start to try to figure out what the next permutation of our economy is going to look like. And if that is slower, then spending will slow.
Cody, appreciate that instant analysis and reaction. Thank you for joining us.
Sure. Thanks, Jeff.
NVIDIA CEO Jensen Huang announcing a new partnership with General Motors earlier today at NVIDIA's GTC event.
And so today, I'm super excited to announce that GM has selected NVIDIA to partner with them to build their future self-driving car fleet.
Now, for more, we're bringing in Yahoo Finance senior autos reporter Praz Subramanian. Praz.
Yeah, kind of another big kind of OEM notch for Jensen Huang and Nvidia with GM now partnering with them to not only partner with them to not only develop their self-driving cars, also for factory optimization, simulation types of activities with AI and also enterprise. So kind of a bigger deal than just the cars itself. But like I said, another big win for Nvidia here. They have Toyota, they have Mercedes, they have a bunch of others OEM partners that are signing up for their business. And it's a small business, right? It's around $2 billion last year, but they say it'll be $5 billion, the auto business for Nvidia. So it's a growing subset, not obviously tiny compared to their the Blackwell business, but also something that's really exciting from the automotive point of view is what Nvidia can do to power those initiatives for those cars.
Yeah, and some of the other chip makers also have been really getting, Qualcomm, it comes to mind, for example, because those are rapidly growing parts of the business as well. So it makes sense that they would kind of try and push in that direction. On a day when we are focused on self-driving and some of the innovations within the driving space, we also have to talk about another big innovation that was announced by a competitor of Tesla. We're talking about BYD in China, introducing what it says is super fast charging.
Right. So they hit this amazing milestone of 1,000 kilowatts into a battery, which would charge your battery in 5 minutes from like 0 to full, which is quite amazing, which is basically almost the amount of time it takes to pump a gas tank full of gas. So that's a big milestone. Tesla's at 250 kilowatts, so about a quarter of that. So that's a jump we're seeing. I mean, kind of remarkable that we're seeing that now in this day and age with BYD. And you mentioned BYD also. Just going back to self-driving, they actually have their God's Eye system that came out a few weeks ago. They're rolling out to customers in their cheapest cars. So that's a big sort of hit for Tesla. But there's a couple other things I want to note in China here that might impact Tesla's businesses. You have Xiaomi, the device maker, with that really popular sleek SU7 sedan. They're upping production from 300,000 to 350,000 this year, EVs this year, which is big because they can't actually meet demand right now in China. Finally, and also Zeekr. They're also in the self-driving space, releasing a free program, a pilot program for their buyers to use their self-driving software. Tesla just yesterday announced that 1 month trial. This one might be a little bit longer, we're not sure, but just sort of on the heels of what Tesla's doing. All these competitors, cheaper cars, better technology perhaps, interesting designs, all happening right now in China.
All right, Praz, thanks for the update. Appreciate it. Now let's get a check on the markets. Jared Blickery standing by with the latest moves. Jared.
Well, thank you. I thought I'd start on semiconductors, then I'll go to the general markets, but not what a lot of investors might have expected for today. We're seeing a lot of red here with a few exceptions. Intel, a competitor of Nvidia, up 1%. But let's just chart Nvidia real quickly. This is a year to date. You can see it's down by about 13.5%. It is off of the lows down here, but we're seeing a little bit of negative action today and kind of in a holding pattern. And that's where the markets are writ large, it seems. And we can look to the Dow, the S&P 500, the NASDAQ, the Russell, and they're all kind of in a very similar situation, which is to say they are up off of their lows, and here's a year-to-date chart, and just kind of trying to figure out the next move. We're coming off this big two-day rally. Investors were hoping for some continuation today, but we're really not seeing that. So back to the main point here. Let's take a look inside the NASDAQ 100. A lot of weakness here, especially in some of the larger issues. And although Tesla's down 5% today, a couple of other Mag 7 names were really catching my eye in terms of their charts, just looking generally weak. And the first is Meta here, which is down 3.5% today. Let me put on a year-to-date chart where you can see it has now hit the lowest point of 2025 only today. If I put a one-year chart on, you can see it's not a disaster. You can see it goes back to about December of last year, that low. However, this comes after, remember, we had 20 days in a row for Meta here. And so that's kind of ancient history right now. Alphabet is the other Mag 7 stock I've been looking at some weakness today. This is also a one-year chart, and we are now looking at the lowest levels in Alphabet since going back to September. And I think these two stocks are notable because they have undercut. They have put in the lowest prices of the year. And so is that a sign that we're leading down with some of these other mega caps? Remains to be seen, but that is a broad-based weakness that we're seeing today. Julie?
Thank you, Jared. Appreciate it. Well, the U.S. Central Bank is expected to hold rates steady after its two-day meeting. Some economists projecting the Federal Reserve won't even cut rates this year or next. But as Trump tariffs stoke economic worries, what does this all mean for the potential of a recession? Here to discuss, Yahoo Finance's Jennifer Schonberger. Hi, Jen.
Hey, Julie. That's right. New softer economic data coupled with fears that perhaps Trump's tariffs could lead to recession have some asking whether the Fed could stave off a recession by cutting interest rates. In short, yes, the Fed could preemptively cut interest rates, so-called insurance cuts to cushion the economy, but the Fed's unlikely to cut unless there is an actual deterioration in the economy or the job market. Inflation has not come back to officials' 2% inflation goal, and some Fed officials are already factoring in upside to inflation because of tariffs, something that would probably prompt officials to hold rates at current restrictive levels of 4.25% to 4.5%. Of course, if growth suffers from tariffs and the Fed holds rates steady, those factors together could push the economy into recession.
And Jen, meantime, President Trump has picked Michelle Bowman to replace Michael Barr as the Fed's supervision head. Tell us more there and what that does mean for the Fed.
Yeah, Josh, banks certainly cheering the nomination of Fed Governor Mickey Bowman to be the new vice chair of supervision. Bowman staunchly opposed former vice chair of supervision Michael Barr's plan, known as Basel III, to significantly ratchet up capital requirements on banks as much as 20%. She argued that would significantly harm the economy. The former Kansas banking commissioner has advocated for tough rules that are already in place and regulations that should be tailored to banks based on their risk profile and size, because otherwise it could hurt lending in this economy. And guys, I just want to say that Treasury Secretary Scott Bessent made very similar points to what we've heard from Fed Governor Bowman over the past 2 years, the notion of tailoring regulations, making them more efficient, more effective. So clearly, Bowman very much in line with what the Trump administration wants. She will, of course, have to have a Senate confirmation hearing. No word yet on when that will be, though when it does happen, I do expect that she will be confirmed. Back to you.
Thank you, Jennifer. Appreciate it.
Yeah.
Stocks pulling back today following 2 days of gains. For more on the latest market moves, let's now welcome in Bill Davis, Stance Capital, founding partner and portfolio manager of the Hennessy Stance ESG ETF. Bill, it is good to see you. So I want us to maybe start broadly, Bill, because I got red all over my screen again. Sell-off, it's being led by tech here. I'm just curious what you make of the market action, Bill, and it, just as a long-time investor, what you expect ahead.
Yeah, well, Josh, thanks for having me on. Good to see you. I think, I think a lot of what's getting talked about today is its geopolitical risks, and I actually don't buy that. I mean, the reality is there's been a war in Ukraine for years. There's been a war in Gaza for now years. The reality is this is an economic war. It's like mostly self-inflicted, and it is clearly creating confusion and fear and loss, lack of confidence. And by the way, you combine that with consumer debt at probably an all-time high, like credit card debt. And it's basically leading to lowered estimates like everywhere. I mean, you would expect this in consumer discretionary, right? And I think that the consensus estimates now have earnings revisions down 11% from where they were a couple of months ago. But it's important to note every single sector of the economy is facing downgrades and earnings revisions. And so I think that has a lot to do with it. But at the same time, I think it's important to note that to some extent, a little bit of this is healthy, right? I mean, we've been through 2 years of just everything being dominated by mega cap and Mag 7 and AI and the reality is that we are now, I think, starting to rotate away from mega cap names, and for a variety of different reasons. And there's obviously different ones that have different drivers going on. But there is a broad rotation away into areas like healthcare, some sectors of financial. And I would say the rotation would be a whole lot broader if it wasn't for the tariff, the threat of tariffs and the fear of tariffs and potential trade wars. And this is something that we know a bit about. I mean, I'm a portfolio manager within Hennessy funds. It's 17 funds, $4.5 billion of assets, all essentially driven by high conviction managers. And so markets like this look a lot like equal weight markets where, if you go back 30 years to the inception of the equal weight index, there's been a couple of moments in time. Obviously, the dot-com bubble was one. The mega cap rampage was another one. where market cap weighted portfolios dramatically outperformed equal weight. But, for example, after the dot-com period, for the next 16 years, equal weight outperformed market cap weighted S&P by 300 basis points a year. So I think we are, in fact, rotating back to an environment like that. And I think that rotation is being suppressed by all of the trade war stuff.
It's interesting, Bill. I was actually looking at a ratio of the S&P equal weight to the S&P 500 over the past 5 years, because indeed we have had this broadening conversation really for the last year that it was expected to come. And there have been some fits and starts. So basically what this chart shows is when it's trending down, that means you have a narrowing of that rally. When it's trending back up, as it is at the moment, it means you have a broadening with the equal weight outperforming on a relative basis. But man, those are little fits and starts, right? So in other words, is what you're saying is that do the tariff headlines need to calm down? Does the trade war rhetoric need to calm down before that broadening can sort of fully take root?
Yeah, I think so, Julie. In fact, I think you and I were talking about this about a year ago.
That sounds right.
I have been thinking that this was going to happen sooner than it ultimately did, but I do think that this is the beginning of it. And again, I think, for example, you would see retail banking doing pretty well. In fact, it started doing pretty well at the beginning of this year until the tariff talk dominated. And certainly sectors of the economy like, think about home improvement, like Home Depot and Lowe's, they're absolutely getting killed by this. So, but you are also seeing smaller cap names with much more participation, and you're seeing it in, pockets of the economy that were largely ignored over the last, handful of years.
Bill, I'm curious, you're a longtime ESG manager, Bill, and investor. So I'm curious to get your take. How has Trump moving back into the White House, Bill, how does that kind of just broadly impact the ESG landscape?
How much time do you have?
We're short on time, but I know you can do it succinctly, Bill.
Yeah, so look, it's ESG investing isn't going anywhere. And I say that as an investor, but I also say it as the companies that we are investing in. They are not really backing down from their commitments. There are some exceptions, which I'll mention, but in general, I think what everybody recognizes is that to deliver sustainable profits down the road, you need to be managing these off-balance sheet issues, whether they're environmental or governance-based or societal, or most likely all three. So most well-run companies are doing all of that already. They're just kind of going underground about it. And one of the reasons why they're going underground, here's a good example. And by the way, this is a name in our portfolio right now, Target. Target backed away from its DEI principles, I think in late January. A national boycott of Target began February 1. I read today that they've had 5 million fewer customers enter their stores during this time period, and the stock's down 22% year to date. At the same time, the flip side of that exact same story is Costco, which is basically facing a sort of like being enveloped in love by customers as a result of them reaffirming their commitment to DEI. And they've had, I think, 7.5 million more people come in. Their stock is, I think, about even for the year. It would probably be up quite a bit were it not for the trade stuff. And then, of course, the big obvious example is Tesla, which is an example of how to just absolutely destroy a brand and a company. And like, I've never seen anything like this. It's going to be interesting to see if they can ever recover from it. But when like the entire world doesn't want to buy your product, and you've managed to alienate future customers, existing customers who are, trying to get rid of them as fast as possible, and the stock is in a free fall, it points out something really important, which is we can talk about Trump all we want, but the reality is that ultimately consumers decide the brands that they want to support, and they're the ultimate arbiters of ESG behavior.
Bill, it is always great to have you on the show. Thanks so much for joining us today. We appreciate it. Coming up, Alphabet is testing Trump's new antitrust cops with its $32 billion deal to acquire cybersecurity startup Wiz. More details on the other side when Market Domination continues. Earlier today, Google signed a definitive agreement to acquire Wiz, a New York-based cloud security startup, for $32 billion in an all-cash deal. It is the largest deal in Google's history if it gets approved. Joining us now with more on the regulatory hurdles is Yahoo Finance legal reporter Alexis Keenan. Alexis.
Yes, so it sounds like, from talking to antitrust attorneys, that this isn't going to be a free pass, right? That this is going to get scrutiny by either the DOJ or the FTC, probably the DOJ, because they're the ones who have been scrutinizing Google across the board, and the litigation's already pending. But this $32 billion deal, ultimately, it's expected that it'll get approved. Why? Well, one, it's a vertical merger. Those tend to be less scrutinized, although in recent years, both in Trump 1.0 as well as in the Biden administration, vertical mergers were looked at a little more closely. So definitely the thinking here is that it's going to get a close look. But maybe, just maybe, the Trump administration will have a little bit of a lighter touch when it comes to a vertical merger. Maybe would even make a deal if a deal needs to be made in order to pass muster to make this deal comfortable for all parties involved. You have to look back at the Biden administration, where these parties already decided, in part based on regulatory concerns, that they would just walk away from this deal. So the parties, though, they seem to be pretty confident. You have a $3.2 billion breakup fee in this deal that Google would have to pay if it doesn't come to pass. Also, attorneys say no matter what, it's going to get at minimum a second request. And that's where the regulatory agencies, they ask for more details about the deal so that they can properly evaluate its impact on the market. So we don't have the figures exactly for the cloud cybersecurity market. Now, Google is not really in that market. They are in the cloud security market, but not cloud cybersecurity market. So if you look at Amazon, front runner, 30% in the cloud market, followed by Microsoft Azure at 21%, Google there with 12% in that particular market. That's probably going to matter to the DOJ or the FTC too. But the main question that these regulators are going to want to answer is whether Google will scoop up Wiz and then use that strategically to start blocking its competitors, these rivals, these big tech rivals and other rivals, little tech too. Are they going to use that to block that service from those rivals? That's going to be the main concern. So a lot of story to be told here. Timeline-wise, the pre-merger notice period, it's been stretched out a bit because there are some new requirements or new thresholds that the DOJ or the FTC can look at. And also, you have to throw into the mix that the Trump administration has really said they want to be conscious, I guess, of AI-related enforcement. So you could argue maybe that there's a tinge of that here, because certainly as the AI market gets bigger and bigger, cybersecurity in the cloud is all that more important.
Right.
Yeah, I remember when it was on the campaign trail, Alexis, Trump would kind of make this distinction between what he called big tech and little tech.
Big tech and little tech.
Like the latter. The former, not always a huge fan.
Yeah. So
we'll see how this plays out. Thank you,
Yeah.
Alexis. It has been a bumpy few years for Nike, with shares of the sneaker and apparel giant having lost more than 60% of their value after hitting an all-time high in November 2021. The drop pushed the company to oust CEO John Donahoe and lure longtime Nike exec Elliott Hill out of retirement to replace him. With Nike set to report earnings now after the bell on Thursday, investors and sneakerheads alike are hoping to learn more about Hill's vision for the company moving forward. Joining us now to talk about all this is Anna Andreeva, Piper Sandler Managing Director, Footwear, Softlines, and Global Brands. Anna, it is good to see you. So Nike earnings on deck. What are you looking for, Anna? What are the big questions you want answered?
Thanks for having me. It's great to be here. So for Nike, it's a turnaround. They're rationalizing the marketplace for the past couple of quarters already. So we're watching for evidence, how that's proceeding. They became too dependent on some of the core footwear franchises like Air Force One, Dunks, and Jordan 1. So progress with removing, some of the inventory in those franchises is really important, as well as I think we will get some direct directional color on how we should think about fiscal 26 estimates. So that's, some of the kind of KPIs that we're looking for.
And how do you think they're doing? I know that you've been doing some channel checks, Anna. So if we talk about those two elements, right, or two problems, the sort of glut of shoes that had been on the market, so now they're trying to work down that inventory, and then the lack of innovation, so they're trying to fix that problem. How do you think they're doing so far on those two fronts under Elliott Hill?
Yeah, so it's very early days. We upgraded the stock in early January, arguing that profitability of the business at the current high single-digit level is pretty depressed, for Nike, a global, footwear and apparel player at scale, and that now they finally have the right leadership in place to execute this turnaround. But turnarounds really are seldom linear, especially in this environment, and this is, again, early days. So some of the things we're watching is, you mentioned it, how our inventory is looking, and especially in North America and China. These are obviously really key regions for the business, as well as some green shoots with innovation. We have been encouraged by some of the newness out there. Vomero 18 is a shoe that has been doing well and selling through. Pegasus Premium, as well, is something that the company has talked about, and we are seeing evidence of the sell-through there. But again, it's very early days. Nike became very dependent on these lifestyle franchises that I mentioned. So making sure we're getting through those and at the same time seeing the innovation and seeing the demand is going to be something we're watching for.
Anna, Trump is back in the White House. That means tariffs are front and center, of course. How could tariffs impact Nike, Anna? What are you telling clients? How should Nike investors think through that?
Well, that's definitely a huge, overhang for the space, been a big overhang for the stocks. Overall, Nike has been moving away from China. Most of the footwear manufacturing now is made in Vietnam, but there is, some China exposure for apparel, and obviously the environment is really uncertain. So this is something that we're watching, every day, and so far, the sector has been undergoing through some pain, for sure.
And how vulnerable is Nike to some of these consumer headwinds that seem to be increasingly of concern? When you get companies like Walmart talking on their calls about, customer sensitivity, how does that then feed through to a company like Nike?
Yeah, no, that's definitely something to watch. And coming into 25, so far, some of the color from companies has been that of concern. There's just a lot of volatility with the consumer sentiment, which makes sense, and that's really affecting demand. And we're seeing some of the higher income consumer confidence, step down as well. I would say over the last few years, Nike has lost a lot of share. They're still a dominant player in this athletic, footwear and apparel space, but they're coming off, a pretty low base. So definitely, a concern for them as well as some of the others. But we will be watching if there's enough innovation, ahead to really move the needle.
All right, Nike earnings on Thursday. We'll be watching. I know you will too, Anna. Thanks for joining us.
Thanks for having me.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.